Welcome back to International Finance. I am Andy Kim, your Dr. Finance. 大家好，开始吧, right? Assalamu alaikum. Vigilance Ihnen. ¿Cómo ça va? ¿Qué tal? Today we're going to finish chapter 5 of Un, Resnick, and Chulun. We're going to talk about the triangular arbitrage, but before we move on further, you may wonder, the background changed, right? Compared to my previous videos, right? You cannot see any books over here. What the heck is going on, Andy? Well, I moved my desk and then changed the structure of my room so that I would be able to do some more picture drawing over here. I like pictures, right? Drawing myself. Of course, I don't draw it well, so you will feel painful. The pain is yours, but the pleasure is mine. That's my philosophy. You like it? All right, so I'm gonna do that. And then I could have done some iPad-based instructions to draw pictures over there and then diagrams like that, but I don't like that. There could be some connection problems between the iPad and the software, so I didn't want to create that uncertainty, okay? So please bear with me or understand it or take it, right? Bite the bullet, right? Just kidding. So I'm gonna start discussing these triangular arbitrage. Well, previous class, right? We talked about cross exchange rate calculations, right? Dollar, pound, euro, right? You always compute. You always have direct quote between US dollars. This is the currency that it's a benchmark currency for all other currencies, right? What about the exchange rate between these two pounds and euros? Is there any direct quotations you can do? Well, you can, but the way we do it is like first compute your exchange rate relative to your US dollars, and then based on it, you compute the exchange rate among these two, between these two, or other currencies pairs as well. Japanese yen, Korean won, the same way. We need US dollars to do that, okay? To figure out the cross exchange rate. Chinese yuan and Australian dollars, yes, you can do that as well. Now, what if there is some discrepancies when doing this cross exchange rate calculations in the market, right? Some guys, some banks may try to do direct exchange, making the market between Chinese yuan and then Australian dollars, direct exchange. I will do that for you. What if that direct exchange rate, okay, is wrong somehow? You make a mistake, right? The bankers make mistakes somehow. Aha! If that happens, there could be some arbitrage opportunities. You guessed it right. Yeah. If that is found, what do? Buy low, sell high. Arbitrage opportunity means like this, right? Arbitrage, strictly speaking, it is like risk less and no cash outlays in the first place. But arbitrage, the essence of it is like buy low, sell high. And which was the lesson we learned from Jim Rogers, right? Mr. Jim Rogers. We were very, very lucky in GBA that 10 of my students and then myself had a chance to visit his mansion in Singapore like 2 years ago. And then he kindly taught us, right? And then he told me to like this, Andy, right? 여보게 Andy, it's like, Andy, please teach the students the most important lessons in finance. 1, buy low, sell high. 2 is don't invest in what you don't know. Here we are going to use his first lesson, buy low, sell high, once you identify this kind of opportunities. So triangular arbitrage will look like this. There is going to be a diagram like triangles, and then we're going to exploit some kind of arbitrage opportunities. So let's go. Triangular arbitrage is the process of trading out of the US dollar into a second currency, then trading it for a third currency, which is in turn traded for US dollar. The purpose is to earn an arbitrage profit via trading from the second to the third currency when the direct exchange rate between the two is not in alignment with the cross exchange rate. Well, more difficult to verbalize, right, than actually seeing the number and doing the numbers. All right, show me that. Right, example here. Okay, let's say there's a US dollar, euro, and Great British Pound triangular relations going on, right? Cross exchange. We're going to do it, and then let's say let me first draw a diagram based on this one. The thing is, let me move this, right? Yeah, and then let me expand myself. Whoa, like this. Okay, now let me write down the problem over here. Okay, so the way I usually do it is put US dollar at the center, right? At the center, US dollar. And then let's say one of the currencies, pound over here, and then euro on the right hand side. Okay. Now, why US dollar over here? Because it's my habit. You know, it's like you always have a direct quote with this benchmark currency in the capital market, right? It's FX market. It's about US dollars, right? So that's why. And then we're going to have some kind of directional movement from one currency to the next, clockwise. So the clockwise movement, I'm going to draw it, the arrow like this, right? And then counterclockwise movement, you can also do that by, should I use different color? Yeah. I'm gonna use purple, no, blue color, like this, right? And then if you look at this arrow, right, the starting point, right, starting point currency will be, I'm going to show like pound, whatever dollar. Per pound, okay, how much is it in US dollar terms? Direct quotation from the US perspective, right? Will be shown like this way. So the pound, the denominator currency is the starting point currency, I would say it. I would do it this way to be consistent, okay? And then if you look at this, the other direction, it's going to be like what? Well, per US dollar, how much is it in pound? Right. So it's a reciprocal relation going on. You see that, right? And this direction and that direction. The starting point is the denominator. Starting point is the denominator. Okay. So we have two other pairs, which is, let's go. From here, it's like a US dollars, denominator currency. And then in terms of euro, you're going to see it like this. And then blue line over there, it's going to be like what? Per euro, how much is it in US dollars? Okay? And then here, so this has to be per euro, how much is it in British pound? And finally over here, it's starting from British pound and then euro. Okay, so we are interested in this. Okay, and let's see, US dollar, per US dollar it is 0.8833 euro. So per US dollar it is 0.8833. 8833 0.8833 yeah. And US dollar per British pound, that's British pound per pound, right? 1.4397 1.4397 US dollars per pound. So if you give British pound, they will give you 1.4397 US dollars to you. Okay. Now, Crédit Agricole, CA, we're going to call it. Crédit Agricole, I don't know how to pronounce it in French. Agricole is making a direct market between the euro and the British pound with an exchange rate of 1.2712, right? So that's this guy, right? 1.2712 euro per pound. Is there an arbitrage opportunity is a question, okay? So the direction wise, right? This is Crédit Agricole's, I would say, CA. Now isn't it Callion Bank? Callion. Now, CA gives you this, but you could have gone through this direction, right? This way versus this way. Are they the same? Otherwise, there is an arbitrage opportunity. Okay? So, how would you make arbitrage profit? By starting with if you find arbitrage opportunities, starting with 5 million US dollars, how would you make money? Okay, that's the question over here. So if we move down, right? Well, one thing you could do, okay, is finding out the cross exchange rate using these two rates. Okay, this is always available to you right away. Okay, this is not. So that's why you want to do some cross exchange computation first to figure out whether this guy is correct or not. Okay, so let's do that. That's this guy. So starting with 1.4397 US dollar per pound times what is this? 0.8833 euro per dollars, right? Then what do you do? Well, these two cancel each other out, and then you're gonna have per pound based euro price, right? So if you do the math, what do you find? So I have Texas Instrument BA2 Plus calculator, which is a standard one for CFA level 1 or level 2, level 3 exams. So let's familiarize ourselves with it. So 1.4397 times 0.8833. So that's 1.2717. Ah, okay. What do you find? We find a discrepancy, right? Discrepancy, right? Over here. So this, of course, the price of pound in terms of the euro, suggested by Callion, right, or Crédit Agricole, is too low compared to what it has to be, right? This is what it has to be, right? 7, but it is only 2. So it is low. British pound is low in Callion, right? This is too low in Callion. So what do? Buy low, okay? Buy British pound from Callion, okay? And sell high to the market. Sell high. Is it high or just the correct price? Yeah, it is correct price, right? Correct price to the other market. So you have to go through Callion, right? You have to buy pound from Callion or the Crédit Agricole, right? So how do you do that? Okay? And here you said, the problem said, you're starting with 5 million US dollars in the beginning, right? 5 million US dollars. So what do you do? Okay? So what do you do? Well, you have to, right, go this way so that you will be able to buy British pound from Crédit Agricole, right? This direction, okay? So you have to obtain euro first and then go to Callion, and then convert it at the lower rate and then give me pound and then go to the direct market and you will earn arbitrage profit. So how does that work? Okay, show me the number. So 5 million US dollars, and then convert it into the euro per dollars, right? And then convert it into British pound, 1.2712. Okay. Remember, this one goes into your denominator. It's a divisor. It's a reciprocal because you are going through this way, right? So 1 over, it's like multiplying. It's like multiplying 1 over 1.27112, right? But I am just placing this guy into your denominator as a big number. Okay, so that's what's going on. Okay, so that's euro per pound. By that, you will have a whole bunch of British pounds. And then what do? Convert it into US dollars in that direct market. Okay, so 1.4397 US dollars per pound. Okay, then what are you left with? Well, do the math. The way I do it will be leave 5 million yet, and then compute the rest of the numbers, right? Compute the rest of the numbers. In the end, you're going to end up with a number that is bigger than 1. Okay, a number that is bigger than 1, which means arbitrage profit pops up. So 0.8833, okay? 0.8833 divided by 1.2712, divided by 1.2712, and then times 1.4397. That gives me 1.00038. Okay, and then if you multiply it by my $5 million, you're gonna have 5001916. I'm going to round up at the last, okay, part. Now this is clearly bigger than $5 million, and you realize that you got $1,916 worth of arbitrage profit by going through this direction. Okay. So triangular arbitrage works this way. Okay. Identify the hole, right, where you can buy low and then get back to the direct market, sell high, and then make a profit. That's it. Okay. Some maybe, all right, there could be some bankers that are like, giving you some holes like that. You identify the profit taking opportunity, you'll be like, let's do the arbitrage, buy low and sell high, and keep on doing it. Now, so already about 20 minutes passed, right? So the remaining part over here tells you about how it works, right? And then here you find that the British pound, what is it? Identify the arbitrage opportunity profit of $19.15 over here. Oh, 19.15 versus 16. Well, round up problem. Okay, it's not such a big deal. Anyway, and then so that's how the triangular arbitrage works. So I'll see you in the next video, and thanks for watching.